Welcome back in, everyone. I hope you're all having a good day today. Today's video, I'd like to go over my entire portfolio, including my taxable brokerage account and my Roth IRA. So let's go ahead and get right into it. This is my taxable brokerage. As you can see, it's right around $40,000. I'm down close to 3% this year. Rough start to the year, but it's still early. And these are my top holdings. I got Adobe, Mastercard, Meta, Google. Those are my four big holdings. And then I have S&P Global, PayPal, Duolingo, Robinhood, Toast, and Netflix. I only have 10 holdings at the moment. And also, let's go over to my retirement, my Roth. I have 3 holdings. I actually have Google, and then I have 2 ETFs, VOO, which is the S&P 500, and then SCHG. I treat this Google, the 7 shares of Google, as basically part of my individual brokerage account. Hello? Here we go. Yeah, so I basically treat it like I have 24 Google shares. I bought all 7 of those during the April bottom, as you can see. So I was buying those shares right around here between April and May. It might have been 160s, 150s. That's where I was buying those, and I had extra money in my Roth. So I went ahead and bought 7 shares, and I don't plan on getting rid of those, at least for the foreseeable future. Let's hop over to Qualtrim. All right, here in Qualtrim, you can see I've put in my whole portfolio, and like I said, I have all 24 of those Google shares, as I'm counting those as my stock portfolio. So those 7 are grouped in with all of my other individual stocks. I don't have my ETFs on here. As you can see, I have Adobe as the highest weighting in my portfolio, followed closely behind with Google and Microsoft, as well as Meta. As you can see, these 4 make up a whopping, what is it? It's over 50% of my portfolio. It's close to 70% of my portfolio, actually, just between 4 companies. These are my biggest bets, and I think I've done this for a reason. I think that these 4 will all outperform the broader market over the next 5-10 years. So I wanted to hop into Qualtrim, go over all 10 of the companies I own, maybe do a quick DCF, and just see what I think about all 10 of my holdings at the time of recording. So Adobe, this one is selling off like crazy, as you can see. Let's go to the 1 year, down almost 32% over the past year. It just hit 52-week lows right around 290 not too long ago. I've been buying the stock since right around here, right around this drop right here. When it dropped under 400, I started buying in July. I've been adding nonstop pretty much, especially when it dropped. Like I added heavy here, closer to 320 in November, and I added like 4 or 5 more shares here in January after this drop from 340 down to below 300. I added 1 share at 295. So yeah, this one's been going through it. The concerns are with AI disruption. We have competition with Canva and Figma eating at smaller customers, individuals like me. I use Canva as well. People are really concerned. As you can see, we're at a forward PE of 13 basically. Let's go to the valuation over the past, let's do 10 years, price to earnings. We're at 18. This is the lowest it's been in 10 years. 2022 drop, it went down to 29. That's not even close. This is cut in half from the lowest. I mean, this thing was trading up in the 60s, 50s, 40s, pretty much nonstop. For the free cash flow yield, it's way up, 8%. This thing's used to trading below 2. The market overall trades around a 3.5, 4. As you can see, they've been taking advantage of this over the past year, 2 years. They've really ramped up the buybacks, so they're destroying the shares outstanding with free cash flow. They're pouring in free cash flow. They're pumping it all into buybacks. They're even leveraging up, as you can see. They're taking on debt to buy back shares. That's all they're doing. They don't pay dividends. Their capex it's accelerating, but it's right around $3 billion in expenses, and they're bringing in $6 billion in revenue. They have plenty of money to kill shares. They are ramping up capex and other expenses to integrate AI into their creative suite. Insane gross margins, 90%-ish. The operating margins are still high. Nothing has changed. The only thing that's changed about this company is people are concerned that AI and Canva and Figma are going to take it over. I see this very similar to how ChatGPT was going to kill Google back in May, April, whenever people were selling shares like crazy. It went down to like a 17 or 18 forward PE. As you can see, this one, free cash flow yield nearing 8, forward PE of 12.8. Revenue growing, let's do TTM, trailing 12 months. Revenue growing 10%, 10.5 over the last 2 years, 13 over the last 5 years. and 17 over the last 10 years. Listen to the last couple conference calls. Management is expecting revenue to accelerate. Total performance obligations, which is basically like future contracts, future subscription revenue that's guaranteed to come into the company. It's accelerating 12%, 14% over the last 2 years. So nothing's really going wrong with this company. They're still in a net cash position, returning money to the shareholder, ramping that up. Just because the stock price is down, they're taking advantage of that. Let's do a DCF. Pull up Adobe here. I think it's very fair to say that they can grow. This is a crazy assumption I had in here. EPS growth, let's just say it's been growing around 15 to 20%. Let's say it slows down to 12. That would be like the worst they've done in decades since they changed to a subscription business model, which was like 20 years ago at this point. So let's say 12% EPS growth annually, and let's say they trade just at a 20. And we're getting 14% annually. And this is like the lowest multiple they've ever traded at, 14% annually with the slowest growth and the worst multiple they've ever had. It says we need to enter at 292 to have 15%, and that's looking at 5 years from now, share price nearing $600. That would be like a super, almost a bear case. For a bull case, let's say they do ramp up, they continue the buyback. It goes to 18 and they trade at this is honestly not even that bullish, but 25 EPS multiple. We're close to $1,000 per share 5 years from now with a 26% annual return. So that is why this is my biggest position. And let's take a look at Google. Google, this company seems to have everything going its way. As you can see, past year up to 80%. It's close to double. It's actually over doubled from these. What is this? April bottoms. Yeah, anywhere under 150, 160, it's a double. So it's a double from here, April, May of last year. So everything's going right. You have Google Cloud margins going insane, as you can see. They were 2%. Now they are 23% operating margins. So revenue is explosive. 13%. Is this on? Yeah, 13%. 13% revenue over the past 2 years, past 1 year. Slowly decelerating, but they have plenty of things still coming their way. Great cash position. Balance sheet's immaculate. EPS. Explosive growth. This is insane. A lot of this is from margins, especially Google Cloud. And other things, subscriptions are ramping up. So yeah, we'll pull up the revenue by segment. Where is subscriptions? There it is. Let's see. If we cancel everything but subscriptions are growing 17% per year, roughly. And it's now trading at a 34 PE. It was at, like I said, like a 16, 17 a year ago, which was absurd. Let's run a quick DCF. Google. They've been growing at 30-ish%. Let's say they grow at 20. They keep the 30 multiple, which is fair. Let's say even they keep it 25. We're still outperforming. We're still doubling. What is it? What is the share price? It's 3. Yeah, we're pretty much doubling in 5 years. So we take that all day. 14%, not bad. If they keep the same multiple they're at now, this is EPS slowing to 20. They keep the same multiple. We're over doubling in 5 years. If they keep the same rates that they're growing at now for 5 years, keep the same multiple, we are, what is that? 369, almost quadrupling the share price. So definitely not selling out of Alphabet or Google anytime soon. Let's take a look at Mastercard, the fourth holding we have. 27 forward multiple, 3.5% cash flow yield. Not asking for much for this company right now. It's selling down. Let's look at the shares. As you can see, the last month, couple weeks, it's down 7%. Past year, it's down 4% for one of the best, widest moat companies in the world. It shares a duopoly with Visa, as most of you know. And they're actually growing faster than Visa. Let's pull up the revenue by segment. Value-added services. This is what they're really pushing. It's fraud detection. It's I forget what they call it, but it's like analytics from say a Starbucks wants to open up a couple locations in whatever area, state, city. They can ask Mastercard to pull like spending habits from the area to see if they think it's going to be a great location or a bad location. So they're ramping up revenue from this 20%. It's explosive. Payment network still growing at 12%, very strong. Total Mastercards, $3.5 billion almost. That's like half the world, which obviously people have multiple businesses have cards. So it's not half the people in the world have them. Roughly 2/3 of the transactions today on Earth are still done with cash, so they still have that tailwind. They haven't even hit half of their total addressable market. Revenues overall, explosive. I mean, it's accelerating. This is the fastest it's been over the past 10 years, 15%, mainly due to the value-added services. EPS is growing at 18% because they're buying back shares. As you can see, shares outstanding. They're buying roughly 2% per year, so that really helps the EPS. The dividend is growing every year, 16, 17% over the past 10, 15% last year. They're returning capital through the dividends and the buybacks. Insanely high ratios. As you can see, return on capital employed 15%. Gross margins nearing 80%, operating nearing 60%. This business is almost bulletproof, and it is being sold off. So I think this is one of the best opportunities in the market. This is my last buy. I bought a share last week, actually. Free cash flow. Yeah, let's look at free cash flow. 3.6 yield. Not much stock-based comp, so 3.5% after stock-based comp. Let's look at the stock-based comp adjusted free cash flow per share. 20% over the past 10 years, 33% over the past year. And this is to a DCF. I think cash flow is the best way to look at this company. I think it deserves it honestly deserves a 3, but we'll say 3.2. Let's say they just grow at 20% per year. You're getting 22% annual. The share prices go from 524 to, so you're almost tripling over 5 years with very low downside risk with Mastercard. I don't see anything disrupting them. I don't see stablecoin disrupting them or government-backed cards or systems, whatever they're trying to run out. I don't see that disrupting them. The 10% cap on credit cards, that's not going to stick long term that Trump's trying to do now. I think this is very reasonable. There's a chance we see 25 and we see this thing trade down to a 3. This is honestly very reasonable too, 30% per year. This is insane returns. I think the worst thing we could see is 15% free cash flow per share, and we stay at a 3.5. Let's say 3.6. It's roughly what we're at today. We still see 15%. So this is an obvious buy and hold. Meta is my next position. My fourth biggest. Pretty much, these are all almost tied. This is one of the widest moat companies in the world. It's got, let's see, where's it at? Family daily active people. 3.5 billion. So half the world uses Facebook daily. And that's not just, that's Facebook, Instagram, WhatsApp, whatever else they have, Threads. Yeah, and then out of the Max 7, I think they're the second fastest growing in revenue. I think Nvidia is the only one beating them. Maybe, yeah, they beat Google close to 30% over the past 10 years, over 20% consistently. As you can see, the price, let's look at that. It got hammered. It was what? Yeah, 800, and then it plummeted all the way down under 600 bucks. I bought one share under 600. I started buying after this dip. I bought my first share at like 700 somewhere after hours this day. This is right after their earnings. They announced they were spending a lot on CapEx, and then I've been adding ever since. So this is a new position, honestly. I bought my first share right there at the end of, maybe it was November actually. It might have been the last day of October. Anyways, but yeah, ABS. Insane. This is low because they had a really big tax hit. I'll show you. Go to quarterly. They had a really big tax expense. This would have been, I believe, close to $8 per share. So if you factor that in, it's insane. Like the EPS growth over 10 years, 36%. It'd be closer to like 40, 50%. I think it'd be 40-ish% over the past 10 years. And that's what's holding the 1 year back. But the 2 year, you can still kind of see, even with this, still 41% over the past 2 years. So everything's going right with this company. Buying back shares. They issued a dividend recently, and the balance sheet's still good. They have more cash than debt. Expenses are ramping up. That's the concern, but they're investing a lot into AI, which, if anything, that's going to help their advertising. They're going to get more for their ads, and if not, they're going to use the compute power somewhere else. So let's do a DCF, Meta. Let's do earnings. Yeah, I already had this in. This is pretty fair. 20%, 25 multiple. And I adjusted the earnings per share over the past 12 months to factor in that one-time tax hit. That's not going to always be there. So we have 20%. That's I believe that was from the big beautiful bill that was passed recently. So we have EPS growth 20%, EPS multiple 25. We're seeing 22%. You see the share price go from 650 to 1.8. So you see a triple. I don't see how you're not buying this. Say something really bad happens. They grow at 12%. They traded at 20 multiple. This is a nightmare scenario. You're still getting 9% returns. You're still getting $1,000 per share for your Meta shares 5 years from now. If something goes way south, we could see this happen where they've been growing at 30%. They get a 30 multiple. They've traded at a 30 multiple for years. You get a 37%. This is, I mean, this looks insane, but this is honestly not unrealistic to see Meta trading at $3,000 per share in 2031, 2030. Hopping over to my fifth biggest position, S&P Global. This company is one of a kind. There's not many. I guess you could say Moody's is similar, but they have different business segments for sure. Moody's is only in the ratings business for the most part. S&P Global has one of my favorite businesses in the world, which is their index business, their indices business. I wish it was a bigger part of their company, but it's not. As you can see, it's growing 13%. But as you can see, the indices business is it's basically the smallest part of their business, because they're spinning off the mobility business. So especially if you don't include mobility, they are for sure the smallest part of the company. The other highest quality part of the company is the ratings business, which is very cyclical, but it's growing over time. Overall, the company growing 11% per year for the past decade. As you can see, EPS, same thing, growing exponentially. 2021, they had an insane amount of debt issuance coming in, so that's why you can see the 5-year isn't as much, because this was unrealistic. But the company's going up and to the right, with revenue up and to the right, EPS up and to the right, free cash flow, stock-based comp adjusted free cash flow per share up and to the right, net income up and to the right, shares outstanding. They had an acquisition here, so that's why this is up. Like, that's why they had this big jump. But other than that, they're buying back 2%-ish per year, leveraged buybacks, because they know the company's undervalued. The balance sheet isn't great, but it's manageable. $11 billion in debt, so basically $10 billion in debt. They're bringing in $5.5 billion in cash flow per year, so they could pay it off in 2 years. No big deal. Now let's go over and look at some margins here. Gross margins very high, 70%-ish, give or take. High 60s, low 70s. Operating margins, and this includes the mobility business, which they're spinning off, which is lower margin. So after that's spun off, this is going to be closer to 45% probably operating margins. Profit margins, we have really good profit margins, closing in on 30%. It'll be 30% after the mobility spinoff. Dividends, past 10 years, 11%. Great for any dividend growth investors out there. Low yield, but the dividend growth is exponential for sure. It's trading at a reasonable valuation. This company is bulletproof. It's a duopoly between S&P Global and Moody's for the ratings business. It's another monopoly basically in the indices. There's hardly any competition. There's a little bit. There's MSCI. They have their they do like the total world VTI. They do some total world indexes, and then Russell has the small caps. But the big one, S&P 500, the one everyone knows about, that is S&P Global. And then also the other parts of their business, other than mobility, which is being spun off. They're all really high quality, high barriers to entry, high switching costs businesses. They're all very safe. We're trading at a 27 forward price to earnings and a 3.4 free cash flow yield. Let's do a quick DCF, SPGI. These look fair. A low yield, let's say. And this is a company that, if rates were to drop after the spinoff of mobility, we could see really, really explosive growth. But this is a fair, base case. Let's see, we're looking at 12%. If we see 13% free cash flow per share growth over the next 5 years, which is very, very, very doable, considering they're buying back 2% of the shares. So you only need 11%-ish free cash flow per share growth. Sorry, free cash flow growth. And that's pretty much doubling us up, close to a double over the next 5 years. If we see any acceleration, we see rates drop, anything like that, and we see it trade closer to what it is historically, a 3.2, 3.0-ish. We're close to 20% per year. Definitely a double up over the next 5. So now let's go to the next one, PayPal. This is probably my least confident pick that I'm in right now. This company is inevitably in a slowly dying business. As you can see, the revenues have just slowed. We went for the past 10 years, 15%, 5 years, 10%, 2 years, 6%, 1 year, 4%. I do expect it to accelerate. They're going into advertising, agentic commerce, a couple other things they have going on. But still, you can see the active accounts, they're basically flat. Transactions per active account, it pretty much peaked here. 2024, it's going down now, but the valuation is super cheap. We're looking at a under 10 forward PE and a 10.5% free cash flow yield, 8.5 after stock-based comp. So if this company were to just grow at I don't know, if they can grow revenue just above inflation, 5-6% per year for the next 5 years, we could see really explosive returns for the stock because of the buyback. Look at this. Shares outstanding. Over the past 1 year, they bought back 4.5%. And the share price is just dropping. I think it's kind of insane. Past 1 year, down 37%. Past 5 years, if you bought the company 5 years ago, you're down 76% today. So luckily, I didn't buy 5 years ago, but I did buy. I've owned this company for, I think, over a year. I believe I bought it at like $65 in 2024 sometime. I don't remember when, maybe somewhere around here. So I bought a little bit here, and then I bought more closer to the April bottom. I bought more PayPal, and I bought a little bit more recently. I have 40 shares now, and my average is close to 70. It's like high 60s, or maybe at $70 per share. So I'm definitely down on the position. It's at $56. But let's look at the DCF. This is realistic. Free cash flow per share growth, 8%. This is almost none because they're going to buy back 5% of the company per year. So we're looking at 3%. So basically inflation. If we see revenues stay flat other than inflation, and we see the free cash flow yield go to an 8, which is fair, we're looking at 14%. So we're doubling up in 5 years. And if we do see some reacceleration through advertising or anything, if I don't know, agentic commerce picks up, if we see cross-border transactions pick up, Braintree continues to grow, anything in the company goes the right way, we see 131. We see 18% per year over the next 5 years. So we go from 56 to 131. I don't like buying into a company that's slowly dying like this. The fundamentals aren't great. It has a lot of competition with Apple Pay, Google Pay. So this is probably the company that will be my next sell out of my portfolio. Let's go to Duolingo. This one, I did not time this right. Let's go to Duolingo. This one, I did not time this right. It's very volatile stock, but it is what it is. At least I didn't buy it up here. I saw it dip here. I believe I started my position here, somewhere around here in the 290s. Luckily, I bought like a 1% position, and then I bought somewhere around here again. It dropped. I've been buying, so now my position is 4 to 5%. This is a very fast-growing company. 35 forward PE, free cash flow 5% yield. Revenue is exploding 40% over the past year, 50% over the past 5. They're almost all subscription revenue, 46% over the past year. Daily users, 35% over the past year. Everything's up and to the right. The only thing is the stock price is going down. So people think AI is going to take over this, take over their market share. But look, I mean, everything up and to the right. This EPS right here, this is kind of fraudulent. They had a tax benefit, so this would probably be somewhere around here where my mouse is, give or take. But the cash is growing. The balance sheet's great. Net income, same thing, had that one-time benefit. They are diluting shareholders, not so much recently, but they're playing for growth. They're investing in the growth. They're trying to grow they're trying to scale, grow their users, and worry about monetization later. But they're still the free cash flow. Even if you go stock-based comp adjusted per share, this is fake because 2 years ago it was. I guess it's not. Let's see, Q3. Yeah. It was just so low. So 272% over the past 2 years, and 73% over the past year. I don't expect that to happen, but let's look at a DCF. I do expect maybe, 30%. That's very reasonable. 30% with a 4 yield. We're looking at 35%. So, I mean, maybe it does get disrupted. I don't believe it. I don't see anyone switching from something that is addicting, like gamified learning, and they actually do teach. Like maybe you're not going to learn a language from scratch on Duolingo, but you will learn something. You will progress. So if we were to see 25% free cash flow growth, which is an insane deceleration, and a 4 yield, let's say a 5 yield, 5% yield, did that update? Yeah, it did. Okay. We're still seeing 24% per year. So I think this company is very cheap. It does have risk. That's why it's a small part of my portfolio, but I'm young. I can take risk. This could be a multi. Like, let's say it goes 40%, and they trade at a company with this growth should be trading close to 3. Let's say at 3.5, 50% per year. 100. I mean, this is a 10x. This is not a 10x, but close. This is like an 8x over 5 years. So that could be a game changer for sure, but I do have it 5%. This is honestly heavy. I don't think I'll be buying any more Duolingo. I don't see it dropping too much lower, but you never know. And then Robinhood. This is another small position, 43 forward. This is a pretty expensive company now. I played this one perfectly. I got really lucky here. I really like the business, but I bought in here. My average is like 33 bucks. I bought it at the bottom in April. Where's it at? Yeah, my average shares is like 34 bucks or something like that. I bought it at the bottom, so I'm up over 200%. But it is growing very fast. It's taking a huge market share with like Gen Z investments or Gen Z investors. So they have a huge market share. Their account sizes are small, but they make a lot of revenue from options trading and the prediction markets and crypto. They take big fees out of those transactions. The balance sheet's amazing. $96 billion company with 14 billion on the balance sheet. So you're basically paying 80 billion for 4 billion in revenue over the past 12 months. So I can see that. Let's see. I wish this free cash flow is flat. We're gonna have to do earnings on this one. I mean, this is just so, like that's unrealistic. Let's just say if they can grow revenues at, I don't know, let's say 30%. Okay, yeah, that's what I had in here. 30 with a 30 multiple. We're looking at 20. I mean, it looks a little expensive today, but they are growing really fast. They're executing well. The company's introducing new products, new things into the platform, like all the time. So I think it's an expensive stock for now, but it could still pay off if they continue to grow this way. So, and then let's look at Toast. No one talks about this company. I don't know why. I think it's very interesting. Look at the revenue. It's mostly subscription revenue, but look at this. It's like literally a perfect straight line. You could draw like a straight line almost perfectly. But yeah, 25%-ish per year. And they finally hit profitability, as you can see, net income. They were losing money nonstop. Boom. So I expect this to blow up. Like, let's look at the ratios. Operating margin. Yeah, I mean, minus 22, minus 36%. But then, boom, once they hit profitability, this should take off. This is 2, 3, 5. I can see this getting 10% operating margins, which would expand this net income. It would double it. So even if they didn't grow their revenue, 27 forward PE, if they didn't even grow their revenue, which they're growing at 25%, if the operating margins just expanded, they could be trading at a 24 PE or something like that. So a little bit of dilution, but they're focusing on growth. They actually did start buying back some shares recently, not too much. So you can see the expenses are still going up and to the right, which is fine when you see free cash flow growing like this. Even stock-based comp adjusted per share, it's still going up and to the right. So let's look at a DCF really quick. And this is a little generous here. Let's just do 30 even. Yeah, if we see a 30 multiple, 30 EPS growth, which is very easy for this company to do, we're looking at a 7% return, not bad. They could do the 40 for sure. Like I said, I expect the operating margins to double at least over the next 5 years, and revenue to continue growing at 20%. So we could see, 15%. That's great. And then there's a chance that this continues to trade at a high multiple. Let's say we trade at a 40. Let's do 35. We traded at 35. We're looking at 20% per year. So I really like this company. They basically are trying to control the whole restaurant, like the whole small to medium-sized restaurant market in the United States, and then let the successful companies, successful restaurants, expand into big companies, and they keep control of those customers. And there's going to be churn because restaurants fail, but they're on top of that. They're gaining market share year over year. And then this is my most recent add to the portfolio, which is Netflix. Only 2%. I timed this buy perfectly for now. I mean, this could continue to drop, but my shares are actually at $80.75. I bought it pre-market, so it's even lower than this. But yeah, so basically I bought it at the 52-week low. Yeah, it's lower than this. So I bought it at the cheapest price I could have over the past year. Still at a 27 forward, but this company is so consistent. Look at this, 10% or over the past 10 years, 20% revenue growth. It's slowing a little bit, but and they have the big Warner Bros. Discovery transaction coming through. So If they were to win that, which I think they will, Paramount is trying everything they can, but at this point, I think Warner Bros. Is just ready to get the deal over with. Um, it could get stopped by the government, but if that were to happen, the company's still going to be fine. It's like a $2 billion breakup fee. They could take that hit. I mean, their balance sheet is not bad at all. EPS is exploding. So let's run a quick DCF. Smallest position, not too worried about this. Let's see, they grow at 20%. Oh, this is cash flow earnings. Yeah, 20%, 30 multiple. We're looking at 17% per year. Great returns. If they return to what they've been doing, 30% over the next 5 years, you know, we're tripling up, almost quadrupling up over the next 5 years. So I like the portfolio. And then just really quick, where are we at? Yeah, these are the 2 ETFs I hold. I don't plan to change this. This is Schwab's growth ETF for large caps. It has around 200 stocks. I put like 2/3 of my Roth into that and 1/3 into the S&P 500. I just sit these in the background. I don't look at them. I don't. If it dips, I'll put $500 into my Roth and buy it. If we see the indices drop 5% or something like that, but I just steadily invest in there. And that's all I've got for today. I just want to do a quick rundown of my 10 companies that I have in my taxable brokerage and just kind of show you what I have in my Roth too. I don't really touch that, but as you can see over the past year, I'm up 16% in my individual account. We were up, what is this, 22, 23% in October. Hopefully we keep this up over the next 5-10 years. 15%, you double every 5 years. Over time, hopefully the compounding will kick in. As you can see, it's already strong. 1 year, $5,500, not bad at all. So that's all I've got for today. I just wanted to go over my portfolio really quick. If you have any questions, drop them down in the comments. And don't forget to subscribe on your way out. Have a good day.